course earlier, we finished our discussion of the variance analysis. Of course, we focused upon only two items within the variance analysis, which were the direct materials and direct manufacturing labor. Of course, when we start with the next chapter, we are going to focus upon the variable manufacturing overhead variance analysis and also the fixed manufacturing overhead variance analysis. We only have 1 point left in our chapter in order to conclude our chapter, which is the definition of something called, or a costing system that is called a standard costing. Of course, we are going to understand the standard costing according to what we took in Cost Accounting 1. We took two terms, one which was called actual costing, and the other was called something normal costing. Of course, we took these two terms in Cost Accounting 1 when we encountered the topic of job costing, as we can remember. So, what do we mean by actual costing, and what do we mean by normal costing, and what are the differences between these two costing systems? I told you to come prepared and go through these terms. So what is the definition, or what do we mean by a normal costing system and an actual costing system? What is the differences? Of course, any costing system is concerned with the tracing of direct costs and the allocation of indirect costs. Therefore, the actual costing system, the normal costing system, and also the standard costing system does just that. They trace direct costs and they allocate indirect costs. But the way they do it is the difference between these costing systems. According to the actual costing, we trace actual direct costs. How do we trace actual direct costs? We, let us say, determine these costs by multiplying the actual cost rates by the actual quantities of the direct costs. We are talking still on direct costs. Therefore, as we can see here, the term actual costing is because we use the actual cost rates multiplied by the actual quantities of these direct costs in order to trace the actual direct costs to the different cost objects or to the different products. The normal costing, on the other hand, also traces the direct costs according to the actual quantities and according to the actual cost rates. Therefore, also here we are going to trace actual direct costs by multiplying actual cost rates by actual quantities of these direct costs. Therefore, there is no difference between normal costing and actual costing in the tracing of direct costs. The difference is within the allocation of indirect costs. According to the actual costing, we allocate indirect costs, or let us say actual indirect costs, by multiplying the actual allocation rate by actual quantity of the allocation base. Therefore, as we can see here, actual allocation rate and actual quantity of the allocation base. While as in the normal costing, we said that we might have a problem, we might face a problem by using the actual allocation rate. Because we said in order to make control decisions or corrective steps, we cannot wait until the end of the period in order to have or in order to determine the actual allocation rate. Therefore, the normal costing system would solve this problem by using the budgeted allocation rate and multiply it by the actual quantity of the allocation base. Therefore, the difference between normal costing and actual costing is only in this part, in the allocation of the indirect cost part, and only in the determination of the allocation rate, because both uses the actual quantity of the allocation base, whether we are using the normal costing or the actual costing. But the only difference is here, according to our normal costing, we use a budgeted allocation rate, while as in the actual costing, we would use an actual allocation rate. Of course, as we said in Cost Accounting 1, using the budgeted allocation rate would cause us a problem of over-allocation or under-allocation that needs to be considered and prorated or, let us say, written off to the cost of goods sold. Correct? These terms are the same terms that we have taken in the previous course. Now, according to this course, we are going to introduce something new called the standard costing. The standard costing differs from the normal costing and actual costing is that we trace not the actual direct costs, but the standard direct costs, whether they are direct materials or direct manufacturing labor. If you could remember, when we took Cost Accounting 1 and we took the journal entries or the journalization of the transactions within a costing system, we said that direct materials and direct manufacturing labor would be recognized, would be journalized according to the actual costs. But here, as we are going to see now, we are not going to recognize direct materials and direct manufacturing labor using the actual costs, but we are going to recognize them in the accounting information system using their standard costs. Therefore, in order to get the standard cost or the standard direct costs, we are going to multiply the standard cost rate or cost rates by standard quantities of the direct costs. Therefore, as we can see here, we will not use the actual, but we are going to use the standard. That should have been the case, of course, that should have been, let us say, the case according to our expectations. Because the standards, as we said, or as our discussion or previous discussion, that these standards are expected or are determined before the beginning of the year or the fiscal year. Therefore, we might have some variances. Therefore, if we are going to recognize the direct cost according to the standard, according to our expectations. Therefore, we need to expect that we would have some differences between what we have expected and what was the actual direct cost that we have incurred. Therefore, the differences here between the two are the variances that we have calculated according to our previous discussions. Therefore, using the standard costing would make me recognize the variances through our accounting information system. Therefore, we are going to recognize the variances in our journal entries, as we are going to see in our next point. Now, of course, this is the main focus of this chapter, but we are going to discuss also the allocation of the indirect costs. Of course, as we can see here, we use the actual allocation rate. Here we use the budgeted allocation rate. Here we are going to use the standard or the budgeted allocation rate, and multiplied not by the actual quantity of the allocation base as the normal costing and the actual costing, but also we would use the standard quantity of the allocation base. This would be the definition of our standard costing. Therefore, if we are going to use the standard costing system or a standard costing system, therefore we are going to recognize direct costs, whether direct materials or direct manufacturing labor, according to the standard prices, according to the standard rates or cost rates, and according to the standard quantities. And of course, we all know from our previous discussions that these standards would differ, or sometimes would differ, from the actual. Therefore, we also would recognize the variances between the actual and the standard, of course, rates, and of course, the quantities. Any questions? Therefore, now let us move on to the journal entries, how we are going to recognize our direct costs, how we are going to recognize direct materials and direct manufacturing labor according to the use of a standard costing system. Finished from... So who can remind us with the journal entries that we took in chapter number 4, job costing, in Cost Accounting 1? Therefore, if we have purchases of direct materials, we would recognize the direct materials, of course, as an asset, and we would recognize the cash that has been paid in order to purchase the direct materials, or we would recognize the liability for this purchase, therefore the accounts payable or the cash control. Correct? After purchasing the direct materials, we are going to use these direct materials within our manufacturing process. Therefore, the second would be the use of direct materials. Of course, using direct materials, of course, we are now considering only direct materials. I'm not considering all the materials. I'm only considering the direct materials. Therefore, I am considering the part of materials that could be traced in a cost-effective way to our cost object. Because as we said in Cost Accounting 1, if we could not trace it directly, or we could not trace it in a cost-effective way to a specific cost object, it would be considered a manufacturing overhead and would be allocated and would be, let us say, recognized in the manufacturing overhead account. Therefore, I'm only here focusing upon the direct materials. Therefore, if I'm using the direct materials, we are going to recognize the use of these direct materials in an account called the work in process. And of course, the use of the direct materials or the use of the materials would decrease our asset that has been recognized previously, therefore to the direct materials control. Now, for our direct manufacturing labor, or the use of direct manufacturing labor, of course, we are going to pay cash, or we are going to incur a short-term liability, like wages payable, for instance. And of course, if I am saying, or if I'm talking about or classifying this cost as direct, I would recognize these costs onto the work in process immediately or directly. Excellent. Therefore, the work in process would be debited and wages payable would be credited, or the cash control would be. Therefore, these are the same journal entries that we took in cost accounting 1 according to our normal costing or even the actual costing, because we said the direct cost does not change, or the recognition of direct costs between normal costing and actual costing does not change. Now, what if we want to use a standard costing? The basic terms of these journal entries would stay the same. Only the numbers would change, and we are going to recognize something new, which is the variances. This is the only difference. As we just explained, according to our standard costing, the standard costing would recognize only the standard direct costs. Therefore, in our purchase of direct materials, we are going to recognize the cost of direct materials according to our standard price by the amount of $30 per square yard. Therefore, when we purchase our direct materials, we are going to consider the $666,000 as our direct material costs. Therefore, the direct materials control would be debited by the amount of $666,000. But do we need to pay the amount of $666,000? Do we need to recognize the amount of $666,000 as an accounts payable? We only need to pay $600, according to our actual, we are going only to pay $621,600 because, as an accountant now, we cannot recognize more than this amount. Therefore, the amount that was paid or should be paid would be recognized by the amount of $621,600. Of course, we all took accounting principles 1 and accounting principles 2, and we know that we have a problem here. debits, or the debit side does not equal the credit side. Therefore, according to the standard costing, we are going to recognize a new account, which is the price variance in this case, which is the amount of 44,400. So what do you think? A favorable variance would be debited or credited? It would be credited. Why? Because as we said, favorable variances has an effect to increase net operating income. And in order to increase net operating income, we are going to consider, or we are going to treat these variances as if they were revenues. And of course, we all know that revenues are credit or credit balances. Therefore, we are going to add a new account to this journal entry by the amount of 44,400. Of course, we have a direct materials price variance by the amount of 44,400. In this case, or by this, the debits would equal the credits. Any questions? Therefore, as we can see here, the use of the standard costing made it possible for us to isolate and determine the price variance immediately after the purchase, which is a very good thing to have. Because if I waited until the end of the period in order to make my variance analysis, and in order to know exactly what are the variances that were incurred within the organization, therefore it would, or it might be too late to make any corrective actions. But if an accountant recognizes these variances at the time, for instance, if we are talking about the price variance, if he recognized the price variance at the time of purchase, therefore we would know exactly or immediately what is the amount of this variance, whether it is favorable or unfavorable, and we could put a question mark on this variance and in order to interpret this variance. Is it good for us? Is it bad for us? And so on. And if we need to have any corrective actions in order to correct this variance, we could make it in a timely fashion, in a timely manner. Therefore, using the standard costing would give us the advantage of knowing and isolating the variances as quickly as possible. Therefore, if we determine and recognize the variances as quickly as possible, we have the ability to make corrective actions and to have our feedback in order to decrease the disadvantages of these, or let us say the consequences of these variances on our organization. Any questions? Now, if we are considering now the use of the direct materials. Of course, the use of the direct materials, we would debit the work in process control and we would credit the direct materials control. Now, according to our definition of the standard costing, we are going to debit the work in process by the standard quantity and, of course, the standard price. Therefore, according to our budget, according to our standard, according to our expectation, the manufacturing of 10,000 units would have incurred us in direct material costs the amount of $600,000. Correct? According to our budget, according to our expectations, we said that the manufacture of 10,000 units would use up 2 square yards of direct materials with a cost of $30. Therefore, according to our budget, according to our standard, we should have incurred only $600,000. And according to our standard costing, this is exactly what we are going to do. We are going to debit the work in process by the amount of $600,000. Now, the direct materials control would be credited by the amount or according to the $666,000 according to the budgeted price that we have already taken into consideration when we performed our first journal entry when we purchased these direct materials. Therefore, the direct materials control would, because we used in our manufacturing process exactly 22,200 square yards, correct? Therefore, we used up all the amount of the direct materials that is within the direct materials control. Therefore, we are going to credit the whole amount by the amount of $666,000. As we can see here, we have a difference between the credit side and the debit side. The difference here is the same as the efficiency variance that we analyzed in our analysis, by the amount of 66,000 unfavorable. Of course, unfavorable variances would be debited, because as we said, unfavorable variances would have an effect of decreasing the net operating income. Therefore, we are going to treat these variances as if they were expenses. Therefore, we would recognize a direct materials efficiency variance by the amount of $66,000. Any questions?
In the previous
course,
yeah, we was like there were a direct material recognition or something, like a source document.
Yes, the material requisition record. Yes, yes.
Then we recorded the use of direct material. Now we are putting all the direct material in the direct material requisition.
No, this is the same. This is the same recognition.
It's like we are taking all the direct material and putting it in the direct material used.
This is because of our example. We said, according to Web Company, we assume that we have no beginning inventory for direct materials. And we assume that we do not have an ending inventory for the direct materials, of course. Therefore, all the direct materials purchased within this period would be used in the manufacturing process.
It's like we could use some of them in this month and in the next month.
You are correct, but according to our example, this is exactly what happened. We used all of our direct materials in the manufacturing process. We do not have any ending. If we would have any ending, I would not debit the amount of $666,000, and I would not recognize the $600,000 because we did not use the whole amount of direct materials. Correct?
We could use it, but separately.
Of course we could. According to our example, we cannot assume something that is not here. We need to consider the question, we need to consider the example, and according to the example, we are going to make our journal entries. Can we, let us say, have an ending inventory? Of course we can have an ending inventory. Do we need to use all the direct materials in the same process or in the same fiscal year? Of course not. You are correct 100%, but we need to consider the example that are at hand. We are going to see some of these assumptions or broken down in some of the examples that, or some of the problems that we are going to encounter. But according to our example, as they said and as we said, they assumed that we would not have any beginning or ending work in process, beginning or ending direct materials, beginning or ending finished goods. This means that all the direct materials purchased within this period would be used in the manufacturing process. Therefore, we are going to recognize the whole amount of $666,000 as the amount that was used or taken from our warehouses. We are going to use the whole amount of $600,000 as the standard amount that would have been recognized if the standards were as the actual.
That means we are doing that at the end of the transaction?
No, we are doing this when we are using these materials.
Okay, that means we use it all of it one time, not in the fiscal year.
You can, according to our direct materials or the materials requisition record, we would recognize this according to this record, according to this source document.
Yes.
In our assumption, our example, we are assuming that we used it or we used all of the direct materials once in our manufacturing process. Is this correct? This is not correct. This is an assumption. This is why we are saying it is an assumption that we are going to break down when we are going to encounter some of the problems later on. Correct? Therefore, this is an assumption. I'm saying it again. This is an assumption. This is not something that we are going to recognize all of the times. But this is the assumption in order just to understand how we are going to journalize our entries. This is only why we assume this in the first place. Now, the use of the direct manufacturing labor, of course, according to our normal costing or actual costing, the work in process control would be debited and the wages payable control would be credited. Of course, we are going to recognize the costs according to our standard price per hour, or according to our standard rate per hour, and according to our standard quantity per unit. Therefore, we are going to recognize the $160,000 here. We are going to recognize the $20 per hour as a standard, and we are going to recognize the 0.8 hours per unit as the quantity standard. Therefore, we are going to debit the work in process control or account by this amount, $160,000. Because this is the amount that should have been considered according to our expectations. Now, actually, what is the amount that will be paid for the labor? We would pay the amount of $198,000. Therefore, we need, as accountants, of course, we need to recognize this amount as an actual amount, because we are going to pay, or we have already paid, or we are going to pay to pay according to the liability that we are incurring, the amount of $198,000. Therefore, this would be credited by the amount of 198. As we can see here, the debit does not equal the credit side. Therefore, we have some differences. The differences here are both unfavorable. Therefore, both would be debited. Therefore, we are going to debit, first of all, a price variance, and then, or a rate variance, and then an efficiency variance. Therefore, we would have a direct manufacturing labor price variance by the amount of $18,000. And we are going to have a direct manufacturing labor efficiency variance by the amount of $20,000. And at last, of course, the wages payable control by the amount of $198,000. As we can see here, from our recognition of these variances, I am considering these variances in a timely manner in order to perform our corrective steps also in a timely manner. Any questions? Do you have any questions? Let us now consider problem 730, which is one of the basic questions in variance analysis. Who would like to read us problem 730? What is the expected production and sales? 72,000 units. This is the direct materials. What is the expected production and sales? 6,000 units. The direct materials, $72,000 pounds. Direct manufacturing labor, 21,000 hours. Total fixed costs, 1,200,000 pounds. Is it in dollars or pounds? Ah, you mean pounds as in kilograms, يعني. Therefore, this is the quantity. Dollars. This is according to our what? Static budget. Now what else?
Standard quantity, standard price, and standard unit cost are followed for direct material and direct manufacturing labor. Direct material for standard quantity, 12 pounds. And for standard price,
$10 per pound.
And standard unit cost, $120.
This is for the amount, the whole amount, of course, $120. Yes.
Direct manufacturing labor for standard quantity,
3.5 hours.
For standard price,
$50. $50 per hour.
And for standard unit cost,
$175, of course, per unit. This is the standard. Yes, what else?
During 2011, actual number of printed produced and sold was 5,500. Actual cost of direct material used was 668,800.
6,000.
668,800.
66,800.
No.
668,800. 668,800. The direct manufacturing labor 70,400. Give me a book, please. Therefore, actual 5,500. Actual cost of direct materials used was 668,000, based on 70,400 pounds purchased at 9.5 per pound. Therefore, the 668,800 is according to 70,400 pounds and according to a price or an actual price of $9.5 per pound. The direct manufacturing labor 18,500 hours, of course, according to a rate of 51.50 per hour. As a result, actual direct manufacturing labor costs were 952,750. This is the actual cost. The actual fixed costs is 1,180,000. There were no beginning or ending inventories. The same assumption that according to our example. Number one, calculate the sales volume variance and the flexible budget variance for operating income. Of course, if we need to divide the static budget variance, of course, the level 1 analysis would start by comparing the static budget, as we can see here, with our actual. And the level 2 that was asked or required in number 1 is we need to differentiate among two different variances, the selling or the sales volume variance and the flexible budget variance. In order to perform this, or in order to determine these two, we need to perform our level 2 analysis. We need, first of all, to compare the actual with the flexible budget, and second, we need to compare the flexible budget with the static budget. Therefore, this is exactly what we are going to do in number 1. Of course, the difference between flexible budget and the actual is the flexible budget variance. And the difference between the flexible budget and the static is the sales volume variance. First of all, the units sold according to the actual 5,500. according to our flexible budget, we said that we need to prepare the flexible budget according to the actual output or output level. Therefore, 5,500 with a 0 as a variance in units. The static was prepared according to the expectation of 6,000. Therefore, we have a difference of 500. Of course, we expected 6,000. We only achieved 5,500, which is less. Therefore, this would decrease our net operating income. Therefore, this is an unfavorable variance. Now, we have the direct materials. The direct materials, according to the static budget, would cost $120 per unit according to 6,000 units. Correct? Therefore, the direct materials would be, according to our static budget, $720,000, which is the $120 multiplied by 6,000 units. According to our flexible budget, it would be the same $120, but multiplied by 5,500 units, which would equal $660,000. Of course, according to our actual, they gave us the direct materials cost by the amount of $668,800. Therefore, as we can see here, that we should have incurred 660, but instead we incurred 668,800, which is more, therefore unfavorable variance by the amount of 8,800. Now, according to our expectations, we should have incurred $720,000 as direct materials, but actually we have incurred 660 because of the change in the number of units. Therefore, we have a favorable here, 60,000 sales volume variance. Now, the direct manufacturing labor. Of course, the direct manufacturing labor here is, according to the to our question, is 952,750. This was the actual amount. And of course, according to our static budget, it would be $175 per unit multiplied by 6,000 units, which will equal $1,050,000. And to the flexible budget, we are going also to use the $175 per unit multiplied by the 6,000. Therefore, multiplied by the 5,500, which is the actual output level, it would equal 962,500. Therefore, the difference here, we should have incurred 962,500, but we actually incurred less. Therefore, this is a favorable variance by the amount of 9,750. Here, we should have incurred 1,050,000, but we incurred less. Therefore, also, this is a favorable variance by the amount of 87,500. Now, fixed costs. According to our actual results, it was 1,180,000. According to our budget, it was 1,200,000. And it would be the same for the flexible budget as we explained, because the change in the units would not affect the fixed expenses. Therefore, here we have a 0. And here we have, of course, we should have incurred 1,200,000, but we have incurred 1,180,000, which is less. Therefore, a favorable variance by the amount of 20,000. $20,000. Of course, the totals the total costs here would be 2,801,550. The total of the flexible budget variance would be 20,950. How did we calculate this amount? 20,000 plus 9,750 minus 8,800. Now, according to our flexible budget, the total cost would equal 2,822,500. Of course, according to our comparison between the static and the flexible budget, we have 147,500 favorable variance, which is the 60,000 plus the 87,500. Of course, we do not consider or we do not add to these variances the variances in the number of units. You need to make sure that in the exam, for instance, you do not mistake this amount to be in dollars. This is in the number of units. Therefore, it should not be considered or added up on the costs. And according to our static budget, the total costs would have been $2,970,000. Therefore, we have a sales volume variance by the amount of 147,500, which is favorable sales volume variance. And we would have a 20,950 favorable flexible budget variance. And of course, which is the level 1 analysis, which is the static or the difference between the static budget 2,970,000 and the 2,801,550, or the addition of these two numbers, the 147,500 plus the 20,950, it would equal 168,450. Of course, both favorable. Therefore, we would have a favorable static budget variance. This is the first requirement for our question. Of course, requirement 2, we are going to complete it in the next lecture, inshallah, and we are going to complete with our problem solving in this chapter. Thank you for listening, and I'll see you next time.